Okay, let's dive into this. Welcome back to our latest explainer. Today, we're pulling out our scalpels and putting on our detective hats because we're conducting a complete top-to-bottom market autopsy on the precious metal sector. We're going to decode this recent and, frankly, pretty painful downturn across gold, silver, and the platinum group metals. We'll start by looking at the massive macroeconomic forces shaking up the globe right now, and then, well, we'll drill all the way down to the micro level to see exactly how these pressures are impacting specific metals.
Right out of the gate, we've got to ask this central mystery that is absolutely dominating the minds of traders and investors right now. Have precious metals fallen enough? I mean, it's been a rough start to the week for long positions in this group, and the market bleed, it's felt relentless. But as we unpack this story, we're going to look for those crucial clues that tell us whether this is just a temporary shock or a fundamental shift in the market's trajectory. The broader context here is absolutely key. Now, what's really interesting about this is that the story of precious metals right now actually starts with geopolitics. Recent developments in the Middle East have caused a massive ripple effect. These tensions immediately drove up the price of oil. And, well, you know how this goes. When oil goes up, what follows? Inflation fears. Almost overnight, the market starts pricing in reality where the cost of literally everything is going up again. And that brings us to the core of the issue, the dual macro pressures currently suffocating precious metals. Because of those inflation fears triggered by rising oil prices, the market has completely raised its expectations that the Federal Reserve is going to maintain a strict hawkish stance. They're going to keep things tight to fight that inflation. This expectation immediately triggered two massive headwinds for us, a surging US dollar and increasing US Treasury yields. I really want you to remember this because it's vital. This creates a highly toxic environment for non-yielding assets. With a dominant dollar and high guaranteed yields from US Treasuries, the opportunity cost of holding physical metals simply becomes way too high for a lot of traders.
Section 1, Gold loses psychological mark. $4,000 per ounce. Now, for gold traders, this wasn't just a random price point. This was a massive, critical psychological support level. It's basically a line in the sand that traders watch like hawks to gauge market sentiment. And recently, gold completely surrendered this mark. The damage here is clear. After consecutive sessions of really sharp declines, gold didn't just lose that 4,000 mark. It dropped even further, dipping below $3,985 per ounce. The truly fascinating takeaway here is that gold is traditionally your ultimate safe haven asset during geopolitical turmoil, right? But in this specific instance, that safe haven appeal simply couldn't offset the immense downward pressure from that incredibly strong dollar and those rising bond yields we just talked about. The math just wasn't in gold's favor this time. So the crucial point is that gold is currently trapped in a holding pattern. We aren't going to see a short-term trend reversal just based on hope. The market is waiting for hard evidence. Until we get clear, definitive signals from upcoming inflation data and a very clear indication of the Fed's future stance, gold's momentum remains firmly capped. Now, before we get too bogged down in all this heavy economic data, the author of our source analysis provided a really relatable and honestly kind of funny breather in their notes. They wrote, "Anyway, whatever is said, I have to show off my profits first." It's a great reminder that behind all these complex charts and macro theories, there are actual traders out there making moves in the market. And this is exactly what they were showing off, a string of highly successful sell orders on gold. This directly connects our dry, overarching macro analysis to real-world trading outcomes. By understanding that a strong dollar and a hawkish Fed would absolutely crush gold's price, this trader successfully positioned themselves to profit from the downturn. It just goes to show that properly diagnosing the market environment actually yields tangible results. Section 2, Industrial Pressure on Silver. Let's move to silver and see how this builds, because the recent price volatility here is extreme, and here's the key to understanding it. Silver faces even heavier pressure than gold, mainly because it lives a double life. Yes, it's a precious metal for sure, but its value is also heavily tied to industrial demand. When global economic growth expectations slow down and interest rates stay high, factories just produce less. That means the industrial demand for silver plummets. Because of this dual role, silver historically experiences much sharper price swings than gold during these kinds of economic contractions. However, it's not all doom and gloom for silver. There's a very clear step-by-step medium-term recovery path here. First, if we see global manufacturing groups and the rapidly growing AI sector stabilize, the bleeding is going to stop. Second, as we move into the second half of the year, if demand for electronics and clean energy technology accelerates, and keep in mind these sectors desperately need silver for conductivity, demand is going to surge. And if those two steps happen, step 3 is practically inevitable. Silver regains its strong market position. So the opportunity is definitely there. It's really just a matter of timing that industrial rebound. Section 3, Platinum and Palladium Divergence. Now, these are two closely related metals, yet their fates are currently heading in completely opposite directions, all thanks to the electric vehicle revolution. On one side, we have platinum. It's currently being supported by steady demand from the traditional auto industry and a relatively constrained supply chain. In fact, our source notes, they're already seeing early positive signs for platinum. On the flip side, we have palladium. Palladium is facing massive long-term structural pressure. Why? Well, because as EVs slowly replace internal combustion engines, the demand for catalytic converters, which rely super heavily on palladium, is essentially being killed off. And this brilliantly illustrates that exact polarization. Mapping out platinum, palladium, gold, and silver all together shows a really stark contrast. But it is super important to remember that despite the specific EV headwind for palladium, both of these industrial metals could still catch a heavy tailwind. They could both benefit if the broader global manufacturing cycle manages to improve in the coming quarters. You know what they say, a rising tide lifts all boats, even the ones carrying heavy cargo. Which brings us to our final thought for today's explainer. We've seen the macro pressures, we've analyzed the broken psychological support levels, and we've dug into the nuanced industrial demands. So I'm going to leave you with this question to ask yourself as you analyze your own strategy. Is this current precious metals downturn a short-term risk that you need to protect yourself against? Or is it actually presenting your perfect medium-term buying opportunity? The data is all on the table. Our market autopsy is officially complete, and the next move is up to you. Thanks so much for joining me, and keep learning.